So should we buy or sell the 1 to 3 year bond ETF? So first off, read this disclaimer carefully. Then do your good deed of the day by liking and commenting. So here it is, 1 to 3 year treasury bonds. Basically at the 52-week low, 4.54% away from the 52-week highs. Here is the chart. Weekly data points. We have fallen very, very, very far. We are way back to the levels we saw back here in 2005. The interesting thing right here and right now is double bottom. So let me draw it in. Double bottom, which is a bullish, well, potentially bullish pattern. So whenever you see a double bottom, you have to ask the very important question: does the security in question have a history of utilizing double bottoms? Double bottom, a bit of a rally, not like super big here, double bottom, and we did get a rally. If we go further back, you can see that there's been quite a few double bottoms that have played themselves out. As such, yes, there is a precedence for double bottoms working for this ETF. Now let's quickly look here at the dailies. You can quite clearly see here the double bottom forming. This is rather interesting, not like a screaming buy, but definitely something that evokes the bull in me. RSI PPO not at screaming buy levels. It's an interesting low level, but not like a ultimate don't miss this opportunity level. Looking at the dailies, then it's interesting. We are oversold, but relatively recently we explored much lower levels on RSI and also the PPOs. As such, the number one signal in this case is double bottom. And given that this security has a history of successful double bottoms, I think I will give the bulls, I will give them a 6. This is pretty interesting. And now let's look at the seasonality. So to the left here, the average over the last 5 years in green, 7 years in blue, and 10 years in red. Seasonality is a bit messy. Usually some strength into early March, then weakness into late March, then strength. So overall just messy. Looking at the table view. So the almost 1% loss of February is it is the worst February since 2004. You could argue that we then are a bit overdue some strength. March has so far been rather weak. But when you look here at the sum, we usually don't have like a big loss for March. April is, it used to be strong between 2010 and 2014, but recently it's been very messy. And generally speaking here, when you look at the table view, December is a clearly bearish month, just a month you just want to short the shy. But January is very bullish, but you see that many of these other months, at least recently, they've been very messy. So in this case, I will give a very small number for seasonality, just a tiny one here to the bulls. For the fundamentals, I use a separate tool that I cannot show, but yeah, overall it's very challenging when it comes to the fundamentals for the bond market because there are so many different factors in play. So yeah, while you have rising interest rates, which is not good for the bonds, they cannot rise too much because that will disturb other parts of the economy, which in turn means that interest rates must go down to stabilize. So it's just like, imagine like a big board with a lot of levers to pull and adjust. And whenever you move one, you will also move all the others. So it's very tricky. But overall, I will give the bulls 2 here on the fundamentals. Well, let's look at relative performance. Long-term weekly data points. minus 22% correlation with S&P 500, 97% negative correlation with the 10-year yield. So even though these are the 1 to 3 year treasury bonds, there is a very clear correlation with the 10-year yield. Vis-a-vis the TLT, which is the 20-year treasury bond ETF, we have 95% positive correlation. So duration definitely differs between these three, but nonetheless, correlations are relatively predictable. Looking at the short-term correlations, 60% positive with S&P 500, 97% negative with the 10-year yield, and 94% with the 20-year Treasury bond ETF. As such, long and short term, the strongest correlation we got was with the TNX. So let's look at the 10-year yield. TNX, CBO, yeah. So we usually saw, well, we recently saw a bit of a pullback, but now there's strength, and we are higher than we were back in late December, which is a bit stronger than one would expect. So yeah, we did get that projected pullback, but the bulls are really at it again. So let's look here at the dailies. Yeah. So I mean, there's definitely is a rise here in the yield. We are not overbought on the weeklies. On the dailies, yeah, we are pulling back from levels that have a bit of a tendency to trigger some selling. Yeah. Okay. So let's look at the seasonality. So yeah, we usually see strength into later March, but then we do enter a period of significant weakness into June. Looking at the table view, 1.24% so far for March. March is usually bullish for the 10-year yield. April, it's a bit messy. May is also a messy month. So given that there is a negative correlation between the SHY bond ETF and the 10-year yield, it means that if we expect the 10-year yield to go down, then that would be bullish for the 1 to 3 year treasury bond ETF. Okay, so let's look at these two against each other, like T and X. Okay. This is one of the biggest sell-offs we have seen ever in this pair, which means that the 1 to 3 year treasury bond ETF, it's underperformed the 10-year yield in a very just spectacular way. Previous times where we had these lows, we did enter a period of the bond market outperforming the 10-year yield. Looking at the dailies, we did find the support here on RSI. If you look at some previous tests of RSI, we usually see a period of outperformance from the bond market. So this could be interesting. Looking at the seasonality, there is the expectation that the bond market will underperform into, well, specifically this bond ETF underperform into 17th of April, but then outperform March. At least recently, looking at 2021 and 2022, we have seen very dramatic underperformance from the SHY ETF. From a more contrarian perspective, you could argue that 2021 and 2022 were extremely bearish, but it could be that it's so bearish that it's similar to when During the global financial crisis, things looked extremely bearish at the lows for the stock market. So when things looked peak bad, that is when it made sense to look for bullish opportunities. And given that we have seen this spectacular weakness now from the bond market with the yield rising and rising and rising, it obviously means that there's upward pressure on the yield, but simultaneously it could also mean that the move is becoming overextended, such that it makes more sense now to look for bullish opportunities in the bond market than to gamble on even more bearish events playing themselves out. Because, as I said, the tricky thing about the global economy is that there are so many interaction effects that you can't have like a single variable to rule them all. You just can't. So if everyone thinks that the yield is going to just go up and people bet on the yield just going up, it becomes too easy, just too easy. And then you will have it go up too much. Too many people bet on that event. And when you know that you get the greater fool theory. So in the last entrant goes full bull on the yield, that is when the peak is formed. And it's like that for all kinds of different asset classes. So yeah, whenever you see an overextended move, be very skeptical of it continuing because it looks too easy. And when you look at the longer term charts, you will see that the market just doesn't work like that. It's way more dynamic. Okay, I do think I will give I will give the bulls a 5 here on relative performance because of the abnormally bearish sentiment here. So we end up with 3.5 in favor of the bulls. The bullish thesis is, however, notwithstanding all the things I said, it is completely contingent on double bottom playing itself out. If we were to see this double bottom break, that would simply be too bad. And it would simply be a clear sign that there's more reasons to be bearish than bullish, just the way it is. Very important to have a stop level whenever you have a thesis. Okay, so yeah, we have some time left. Let's look at some other securities. Let's actually look at Meta. It's been some time since I looked at this chart. Strong move. Yeah, but not like super interesting right now. Let's look at Microsoft. They have their chat robot, Chat GPT, very like revolutionary AI technology. The stock chart benefited a bit, but not like super big move so far. Yeah. We are reclaiming the red 200-day moving average. That's bullish. The issue for Microsoft is that it's so big that while a small company would move very, very substantially on something like Chat GPT coming under its umbrella, when you are super massive like Microsoft, even that isn't enough. The market needs a lot more. But I do think that Microsoft is going to become a very serious competitor to Alphabet. While we are on the topic of AI, the ticker AI was taken by C3 AI. Yeah, okay, big bullish move, but maybe it's a bit late to come to this party. So when you have a chart like this, that doesn't mean it cannot go higher. Many charts go on to make new 52-week highs, but when it comes to entering a position, then I definitively prefer to have a buffer, because then I will be right if it does continue to make 52-week highs, but I will also be able to be right if it just is a bounce, a little bit of a rally, maybe some short squeeze. Like, the more opportunities you have to be right about the bullish or bearish position, it's very contingent on when you enter that bullish or that bearish position. Like if you short a stock, the moment it makes a new 52-week lows or maybe all-time low, yes, technically speaking, the stock is obviously in a bullish setup. Okay, I mean bearish setup, of course. Bearish, 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 bearish. And that's an annoying thing about the nomenclature of the financial markets is that bull and bear, they both start with B. And they also have they are short words. So when you read like an article or you talk bull or bear, it isn't instantly clear whether someone is talking about something that is means that the asset price will go up or down, because there's a bit of a delay in the processing due to the word. So maybe different words would work better. There is, of course, the term long. If you are bullish, you usually say that you are long. And if you are bearish, then you say that you are short. Those words are more, they're visually very distinct and those sound very differently. But the problem with saying that you are long is that long and short, especially long, it doesn't have the same use frequency. So there's quite a few people that simply will not understand what you are talking about if you are presenting your long theories. They might even think that long means that it's a long-term theory. You are a buy and hold investor or something.